Forecasting and Pro Forma Financial Statements. Pro Forma Financial Statements. Learning Module 5, Lecture 5D. Pro forma financial statements are estimated or projected financial statements that are based on the projected forecasts of sales discussed in the previous section of the learning module. Increases or decreases in sales over the short term and the long term require decisions about the management of other accounts. For example, think about some things that would have to happen in your ski inn bed and breakfast if you were able to accurately forecast a 20% increase per month in sales in room nights between April and October, off-season summer months that you normally have little visitation. What effect might this have on variable expenses, those tied to sales? How about investment in fixed assets necessary to respond to increased demand and business? How about the need for additional employees during these usually slow summer months, and thereby increase salaries and wages to be paid? Would you need to obtain additional financing from debt or equity to respond to this growth in sales, or would the increase in revenue from sales be adequate to respond to this increased demand? In summary, this increase in sales forecasts would require that you consider the impacts across your entire bed and breakfast and how you would respond to those impacts. This requires you to consider the need for financial planning for those summer months. Consider the impacts suggested above and prepare several pro forma financial statements to give you a clearer sense of what is going to happen to your business financially and how you might respond to these changes. This pro forma analysis is based heavily on the sales forecasts you have already done. You will develop three types of pro forma statements: the pro forma income statement, the pro forma statement of cash flows or cash budget, and the pro forma balance sheet. The pro forma income statement can be a relatively simple statement to prepare, particularly for a tourism business with a relatively stable history to refer to. For example, if your bed and breakfast projects that sales will increase by 65% over the course of the following year, it would be a good start to assume that variable costs, in the form of costs of goods sold, would also increase by 65% over the following year. Therefore, the first part of the pro forma income statement is finished. After that, the business would start with fixed costs that would be the same as before. Additional considerations would relate to any other operating costs that, although fixed, might increase with an increase in sales due to management decisions that are made. For example, increased sales might require additional hiring of employees, which will increase salaries and wages expense. The need for additional equipment to respond to the increased business would increase the amount of depreciation expense reported. Will a loan be required to purchase fixed assets or pay additional salaries initially? If so, interest expense for the year will increase. Even though these costs increased as a result of increased sales, they are still considered fixed costs since they are not directly tied to an increase in sales and do not automatically increase or decrease with sales, but are incurred as a result of responding to or preparing for increased demand for your bed and breakfast. An increase in sales, given no unusual related increase in costs, may also reflect an increase in the net profits for the business. This income statement begins with the assumption or forecast that sales will increase by 25% or $50,000 for 2013. Completing the remainder of the pro forma income statement is relatively straightforward if you understand the relationship that individual variable and fixed costs have with sales. The first step in putting together this pro forma financial statement is to consider costs of goods sold. The most basic assumption is that with an increase in sales of 25%, cost of goods sold will also increase by 25%. This is the assumption made in this pro forma income statement, and it is a perfectly reasonable assumption. However, the person developing the pro forma financial statement should consider whether this assumption is feasible. Are the costs per unit of the supplies being purchased by your tourism business to create your own products and services remaining the same, or are they increasing? For example, if the cost to your whitewater raft company of food that you purchase from a wholesaler and provide to your clients on your trips is increasing per unit, this will affect what you forecast for your cost of goods sold. So you don't automatically assume that cost of goods sold will increase the same percent as sales unless you know that the relationship between your variable costs, such as cost of goods sold and sales, is remaining the same. The point is, the forecaster should gather information to determine what that relationship has been, is currently, and will become. Many of the operating expenses are fixed with no relationships to sales. For example, your business should know what it is paying for rent on a building, and if it is to remain the same the following year. Forecasting for the following year's costs is a simple matter. Other expenses may change, information about which is likely available to the forecaster. Some of these costs, though technically fixed costs, will change as a result of increased sales. For example, the increased demand for your whitewater trips may require that you hire an additional guide for the season, or additional office and administrative personnel. This will increase your salaries expense for the year. Perhaps the increase in demand will require that you purchase an additional vehicle to transport clients to the river. This will increase the expense reported for depreciation for the following year with the additional fixed asset. Insurance expenses will likely increase due to the need for additional coverage on vehicles. Perhaps you will need to take out a new loan to purchase that vehicle. If so, interest expense on that loan will lead to increases in that account. In summary, the forecaster will take the additional sales forecasted, then consider likely ramifications for the business in responding to that growth in demand, and forecast how that growth might impact specific expenses on the financial statements. The same is true for a forecasted decrease in sales. An important point to note is that although this statement presents only year-end numbers, the forecaster should consider putting together a pro forma income statement on a month-by-month basis. Seasonal variations inherent to many tourism businesses make a monthly pro forma statement very informative and important to planning for the following year. Many fixed costs, such as utilities, salaries, and wages due to seasonal employment, will vary at different times of the year. Why is a pro forma cash flow statement or cash budget important and next in line? Clearly, the income statement does not always reflect the flow of cash in the business. This is an extremely important consideration since cash flow is one of the most important factors influencing how a business runs its day-to-day operations and even its ability to make longer-term decisions. Why is a pro forma cash flow statement or cash budget important and next in line? Clearly, the income statement does not always reflect the flow of cash in the business. This is an extremely important consideration since cash flow is one of the most important factors influencing how a business runs its day-to-day operations and even its ability to make longer-term decisions. In addition, the pro forma balance sheet reflects the financial condition of the business, which in part requires the accurate presentation of the liquidity of the business and short-term solvency, or its ability to pay short-term obligations. Therefore, before the pro forma balance sheet is developed, it is important to understand how the flow of cash through the business is impacted by the forecasted increase or decrease in sales. A pro forma cash budget projects future receipts and expenditures and lets a business manager know how much and the type of financing might be necessary to maintain ongoing operations efficiently and effectively. Responding to shortfalls in cash by identifying new sources of cash are an important aspect of the budget. Also, managing for excess cash by increasing short-term investments, for example, or taking advantage of volume discounts in purchasing, are all part of budgeting the flow of cash. In general, the pro forma cash budget explores when the tourism business has cash inflows and how they relate to the need to spend cash for obligations and investments. In what areas might the business be able to improve cash flow? For example, through more effective collections on accounts receivable. If the business is able to speed up collections on accounts receivable by 25% per week, what does that do for the liquidity of the business and its ability to meet financial and legal obligations from day to day, as well as engage in short-term investments when excess cash is not necessary? This pro forma cash budget breaks out the sales forecast from the previous income statement by month and adjusts for differences between the flow of cash in and out of the business and the recognition of sales revenue. These will be different due to the collection of some sales revenue through credit sales and the resulting delay in receiving cash from those sales. The top portion of this cash budget reconciles these differences between the recognition of monthly sales revenue and monthly cash flow, or receipts. Following through the receipts for January in this statement will clarify the approach of the forecaster in budgeting the monthly cash inflow for the year. This business has found that 30% of the current month's sales are collected in cash. Therefore, there is a projected cash inflow of $3,900 from January sales, which is 30% of $13,000. The rest of the sales made in January are in accounts receivable at the end of January. In addition, 60% of the previous month's credit sales are collected in cash this month. Therefore, the business receives another $9,450 cash in January, which is 60% of December credit sales of $15,750. Finally, cash receipts of $5,670 are collected from credit sales made 2 months ago in November, or 40% of $14,175. Therefore, the cash inflow in January from business sales is $3,900 from January sales, plus $9,450 from December credit sales, and $5,670 from November credit sales, which equals $19,020. This process is carried through each month by identifying cash inflow as 30% of current month's sales plus 60% of previous month's credit sales plus 40% of the 2 months' previous credit sales. The percentage of cash inflow for your tourism business will be determined by your own experience in the receipt of cash from credit sales. This is an important function of the accounts receivable turnover ratio discussed previously to understand how quickly, on average, your credit sales turn into cash for your tourism business. Moving down the pro forma cash budget to the next section, we see the business's monthly estimate of cash payments through the paying off of its own accounts payable. The business also identifies its month cash payments of operating expenses, such as salaries, rent, utilities, as well as monthly interest payments on loans. Within these first 2 sections of this budget statement, all monthly cash inflows and outflows are recognized. These are summarized in the 3rd section of this statement in the form of total cash receipts, or inflows, and payments, or outflows, to arrive at a monthly net cash flow. Note that in your text, the monthly cash outflow from operations involved total operating expenses minus depreciation expense. This is because although depreciation expense is written off against income as an operating expense, it does not reflect an actual outflow of cash, but rather an accounting adjustment to the value of fixed assets. The final section of the pro forma cash budget is a summary of the flow of cash balances and the cash response to monthly cash surplus and shortage. In January, the beginning cash balance was $4,000, the ending cash balance for December. The business had a cash shortage in January of $1,247, but made up for that by drawing the same amount from a bank line of credit, thereby maintaining an ending January cash balance of $4,000. When the business has a net cash inflow for a given month, see the $593 for February, it uses that amount, or excess, to pay down the balance in the line of credit. Note that the business had a net cash shortage of $2,337 in March, so it drew that much money from its line of credit to make up for that shortfall. Positive monthly cash flows throughout the year allowed the business to completely pay off its line of credit in November, ultimately resulting in an ending cash balance for the year of $8,406. Like the pro forma income statement and pro forma cash budget, the pro forma balance sheet is a projected balance sheet for a future time. It will reflect the increase or decrease in sales forecasted. Increases in sales may be reflected in an increase in current assets, for example through excess cash, and possibly an increase in short-term investments to respond to excess cash, increased inventory to meet expected sales, and an increase in accounts receivable based on the breakdown of cash versus credit sales. It will also be reflected in improved liquidity of the business, improving its ability to meet current obligations, that is, to pay off current liabilities that were either existing prior to the increase in sales or taken on as a result of the forecasted increase in sales. Forecasted increases in sales may also be reflected in an increase in fixed assets in order to respond to this increase in demand. Also, an increase in sales, given no unusual increase in costs, will be reflected in an increase in retained earnings at the end of the year, reflecting an increase in the value of the business. A decrease in sales forecasted may have effects on many of the same accounts with very different impacts. You should go through the balance sheet accounts and think about how a tourism business might be affected by an increase or a decrease in sales. Once the pro forma income statement and cash budget has been completed, the business can complete the pro forma balance sheet using these previously prepared statements, showing the projected financial condition of the business at the close of the following year. I will discuss each major component of the balance sheet in turn in this example. Current assets. The projected balance of cash for the end of 2013 on the balance sheet can be traced to the ending balance of cash on the pro forma cash budget for the end of 2013. The projected accounts receivable on the 2013 pro forma balance sheet represents the forecasted ending accounts receivable for December, $21,000 from the pro forma cash budget, plus 40% of the accounts receivable from November credit sales from the pro forma cash budget, which is $18,900 times 40%, which equals $7,560. So $21,000 plus $7,560 equals $28,560. The projected balance in inventory of $18,750 reflects the 25% increase in sales over 2012 projected and shown on the pro forma income statement. Fixed assets reflect the decision by the business to purchase additional machinery and equipment in response to the projected growth in sales. Note they increased from $30,000 to $43,000. Current liabilities. Accounts payable might increase with the increase in inventory that would likely be purchased on credit. Similarly, salaries payable would increase due to either A, an increase in wages per employee projected for the following year, or B, the hiring of new employees in response to the growth in demand for the business's products and services. The decrease of notes payable reflected the gradual payoff of the line of credit over the course of the year, given projected net cash surpluses throughout the year. Long-term liabilities. Long-term loans were likely taken out in order to pay for the additional machinery and equipment noted by the increase in fixed assets. Owner's equity. This account would increase with the projected net profit for 2013. In developing a pro forma cash balance sheet, it is important to remember that assets must equal liabilities plus owner's equity. Therefore, it is not uncommon to use the owner's equity as an account to balance the overall pro forma statement. Given reasonable estimates of asset and liability accounts, this is often the approach taken by managers preparing pro forma balance sheets. The two sides of the balance sheet, even though it is a pro forma balance sheet, must balance. The previous pro forma balance sheet was prepared utilizing the pro forma income statement and the pro forma cash budget. There is another common method of generating a pro forma balance sheet called the percentage of sales method. This method assumes a systematic relationship between sales level and assets or liabilities. That is, an increase in sales will cause a particular buildup of assets and liabilities which can be predicted or systematically quantified. This approach takes a form of a vertical analysis of financial statements described in Learning Module 3. Based on actual financial data of the business, each balance sheet account is computed as to its percentage of sales for a given period, using the following formula. Percentage of sales equals the balance sheet entry in dollars divided by actual sales in dollars times 100. This formula is applied to the actual balance sheet of the previous year to obtain percent of sales figures for each balance sheet account in the forecasted year. These percentages are then applied to forecasted sales to arrive at a pro forma balance sheet for a particular date in the future. Now let's look at an example of how the percentage of sales method can be used to develop a pro forma balance sheet. This is a very simple statement to develop. Note in the first column of figures, the actual year-end balances of asset, liability, and owner's equity accounts are shown, along with the total sales of $200,000 experienced in the year at the top. The second column of figures shows the percentages of this $200,000 sales figure using a vertical analysis approach of each of the balance sheet accounts for 2012. This percentage is then applied to the forecasted sales for the following year of $250,000 to arrive at a pro forma balance sheet for the end of the following year. The percentage of sales method may also be used to determine the need and level of new financing. The formula for this approach is the change in sales times total assets divided by sales minus the change in sales times total assets divided by sales minus forecasted sales times as S sub 2 times P times 1 minus the owner payout. This is where the change in sales is the sales forecast minus actual sales from the income statement. Assets divided by sales and liabilities divided by sales come directly from the historical, not the pro forma, numbers on the balance sheet and the income statement. S sub 2 is the sales forecast for next year. P is the historical net profit margin, not pro forma figures from the income statement. 1 minus owner payout is the percentage of net income that stays in the business, that is not paid out to owners as income at the end of the year or throughout the year. Now let's look at an example of how the percentage of sales method can be used to identify the need for and the level of new financing using the pro forma financial statements already discussed. You can find these numbers in the pro forma financial statements in the textbook. The change in sales is derived from the income statement and results in a figure of $50,000. Total assets divided by sales is derived from actual historical balances and is 0.3521. Total liabilities divided by sales is also derived from historical balances and is 0.2638. S sub 2 for the projected sales of the following year are $250,000. P is the historical net profit margin from the income statement and is negative 0.195. 1 minus the owner payout assumes that the owners take out 66% of the business as personal income. And 1 minus the owner payout in this case is 0.34. Plugging the numbers into the equation, we get the following figures. 50,000 times 0.3521 minus 50,000 times 0.2638 minus 250,000 times negative 0.0195 times 0.34. This combines to 17,605 minus 13,190 plus 1,657.50. Based on the percentage of sales method and forecasted sales, the business requires an additional financing of $6,072.50. This ends Lecture LM5d on Pro Forma Financial Statements. This completes the lectures for Learning Module 5 on forecasting and Pro Forma Financial Statements.